Welcome to Trading Nation. I'm Dominic Chu. Wall Street is celebrating the longest bull run in U.S. history, and it's doing it on Wednesday. Our next guest, though, warns of a painful sell-off, and it could be coming sometime soon. David Rosenberg is chief economist and strategist at Gluskin Sheff. Welcome to the show, David. So what's your reaction? It's a big milestone. Some people say, by varying definitions, it could be the longest bull run in U.S. history. But is it on borrowed time? Are we in the ninth inning or extra innings? How would you characterize what's happening right now with the market action?
Well, thanks for having me on the show, Dominic. And I think that the way I would approach it is that we are very late cycle. And I think that if you want to define a bull market as being a period of time where you don't suffer a 20% decline in the S&P 500, then you have to say, well, that is a milestone. I think at the same time, we have to take a look at this entire cycle in a certain context of some major public entities providing a major source of support, and I would say artificial support, because I think people should ask themselves the question, if the central banks to this day, 10 years into this expansion, I'm talking about the G4 central banks, hadn't accumulated $15 trillion, that's with a T, $15 trillion of assets on their balance sheets, where would global stock markets be today, including the SPX? I think that's a legitimate question, so we can celebrate this, but let's put it in a certain context.
Well, here's what I would say, though. They have, let's say, they've bought $15 trillion worth of assets, and they're still there. They may not be buying as much of it, but there's still a market presence, even if they're unwinding a little bit like the Fed is doing right now. Does that mean, though, that the conditions are in place for this bull market to keep going higher?
Well, what I'm saying is that, if you're going to sit there and say that this is all about earnings, and, of course, we have a couple of quarters of earnings being juiced up by fiscal policy. And if you think that this is about just the economy, I mean, keep in context how weird it is to have the longest bull market, as you say, in equities in the context of the weakest economic expansion of all time. And how do you square that circle is because of the long arm of the central banks, not just central banks, but also sovereign wealth funds. Really, we're talking about non-private entities that don't have to satisfy unit holders every day, every week, or every quarter. So there's a dynamic going on here from the demand side as to who's actually been buying up the paper. And on the other side, of course, has been this rampant equity buyback craze. So a lot of the stock market strength has come less really from earnings, notwithstanding the past couple of quarters, which I think is going to be more temporary from fiscal policy, and more the dynamic of demand from central banks buying risk assets on their balance sheet. I mean, the fact that you still have Japan and most of the European countries still have the front end of the yield curves negative in nominal terms. I mean, German bonds are negative 60 basis points, minus 40 in France, minus 10 basis points in Japan. This has, impacts on risk assets across the globe. Now, what's happening, of course, now is that the Fed is tightening monetary policy. These other central banks are becoming less accommodative. And so we are going to be running the movie backwards. I'm not actually going to sit here and say we're going to have a painful decline. I am saying that you could say on the one side, well, we've managed to go into a record-long bull market here. But what's interesting is that in the past couple of months, what has led the market back close to the highs have been the defensive areas of the market. Take a look at the past 3 months, and it's been healthcare and staples and telcos, to some extent utilities, that have taken over the leadership. And those are the things that you actually want to own when the economy is going to be slowing down, which I'm sure it will after the peak stimulus that we got in the second quarter. So I think that's something else that's very interesting in this market is who's emerged as the leader. In the past 3 months, the defensive sectors of the SPX have outperformed the cyclical sectors by 1,000 basis points.
So David,
I don't see that mentioned anywhere.
No. So that's an interesting point. So as you take a look at that in context, like you said, what is it then that takes this market down, hypothetically? I mean, we can't predict the future, consistently. But in your mind, given that story you've just told us, what exactly leads us to the downside? And then what is it, and how deep does it become?
Well, I think there's really two things. The first is, when are we going to start to see earnings disappointments? It's been quite a while. We came off the first quarter, second quarter, where there's no doubt that the earnings not only were decent, but beat expectations. So you'd have to have some estimate as to what's priced into the market in terms of earnings. And keeping in mind that the bottom-up consensus for 2019 is 10% earnings growth. Yet the economists think that we're going to have sub 5% nominal GDP growth. I don't think next year, once the fiscal stimulus is behind us, we're going to have earnings running more than double nominal GDP. I think that game is over. So it's really a matter of timing, and that's not really my specialty, but it's out there that I think that it's either in the first quarter next year, we'll probably start to see earnings estimates come down and more earnings disappointments than we've seen over the course of the past several years. Now, the other thing is that the real big bubble is not really in the equity market writ large. It's in the corporate bond market. And we have this unusual situation now where 55% of the investment grade market is now triple B, and the amount of leverage underpinning the triple B space right now, which is a $3 trillion market. Remember, subprime was $1 trillion. This is $3 trillion. And when you're taking a look at interest coverage or debt to EBITDA ratios, they're far higher than they were at the peak of the last cycle. So if you're going to ask me what the big risk is, the big risk is in the corporate bond market. If we get, in the next, say, 12 months, give it, preponderance of these triple B companies slipping into junk bond status where the pension funds and insurance companies can't own this debt anymore, these spreads are going to blow out. We're going to have a severe tightening in financial conditions, and that's going to reverberate right back into most risk assets, including equities.
Right.
So that, I think, is what the story is going to be in the next 12 months. You have to always identify when the Fed went crazy easing policy and stayed easy for too long, you got to follow the bubble. The bubble in the late 80s was commercial real estate. The bubble in the late 90s was technology. The bubble in the last cycle, as we all know, was in housing. The bubble this time around is on corporate balance sheets after years of this craze of issuing debt to buy back stock. There's going to be a payback for that, especially as the Fed raises interest rates and the ability to service these debts for marginal companies that constitute the triple B space begin to default.
Well, we do know, as many do say out there, credit leads equities in many cycles. David Rosenberg, thank you so much for that view. Of course, that's probably one of those things that many of us don't want to see, but certainly something that we're keeping an eye on. And thanks for joining us today, and thank you for watching Trading Nation. I'm Dominic Chu. We'll see you next time around.
Hey traders, did you like that video? There's more where that came from. Scroll down and click on the links to the right of your screen. We publish new videos and commentaries from our experts every day. And don't forget to follow us on Twitter @Trading Nation.